I was talking with someone today, and we were discussing, Matt Riley, he and I, and we both agreed that $6,000 gold by July of next year would fit the bill. And a lot of that would be revaluing gold, perhaps, whether it just be the way that it's doing right now organically. But when you look at the debt, when you look at all these things we came up with, it was a long discussion. $6,000 gold by next July. That's a big number. I get it.
It is.
But
I will tell you,
why not? I wouldn't dump it at all.
The gold market experienced a sharp pullback just a day after reaching an intraday record high above $3,500 an ounce. Despite the sudden correction, analysts remain confident that the rally is far from over. Many believe gold remains significantly under-owned and, by several measures, still undervalued. AndySchectman, CEO of Miles Franklin, rebuffed the notion that gold is overvalued, calling it a myth. He pointed to the continued distortion in gold prices caused by the practice of rehypothecation, where the same physical gold is promised to multiple buyers through paper contracts. This layering of claims creates an inflated sense of supply, masking the actual scarcity of physical metal. Gold has risen more than 26% since the beginning of 2025, driven by a combination of central bank accumulation, geopolitical tensions, and substantial investment demand amid growing concerns over trade wars and monetary instability. In Schectman's view, a $6,000 price target by July 2026 is not unrealistic. He emphasized that when one considers the broader macroeconomic landscape, including rising debt levels and shifts in global monetary policy, such a move becomes not just possible, but plausible. Whether this rise occurs through an official revaluation or organic market momentum, the long-term direction remains firmly upward. A notable shift is also taking place in investor sentiment. After years of relative disinterest, Western investors are significantly re-entering the gold market. As of mid-April, North American and European investors had collectively purchased around 240 tons of gold through bullion-backed ETFs, according to the World Gold Council. This marks a significant reversal from the 441 tons sold over the previous 3 years. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
You're seeing this exact same thing in China. They just came out with their new renminbi cross-border bridge. It's the M bridge. It's the technology of M bridge. They've connected, China did, with, I believe, 11 or 12 of the ASEAN countries in Southeast Asia, along with 5 or 6 Middle Eastern countries, represents about 40% of GDP, and it now can trade outside of SWIFT. And Lavrov, the finance minister from Russia, said something really big for all you BRICS naysayers. He said the new system that we will issue will be open to non-BRICS nations as well. Now, think about the Belt Road Initiative that China uses. 75% of human population, 50% of global GDP. They are not all BRICS countries, of course. Most of them aren't, but they're aligned with China and the BRICS. Think of the Eurasian Economic Union. They're not all BRICS countries, but they are aligned with the BRICS. So you're talking the majority of human population will have the ability to trade digital renminbi over this new bridge system, which sidesteps SWIFT. And then at the same time, they will settle imbalances in gold. And this is like the unit settlement token, which they've told us is 40% gold back. That's coming. In the meantime, they're just using physical gold to offset imbalances in currency or in trade surplus. It's happening. And you're talking about the majority of the world. It doesn't just have to be BRICS countries. That's a big deal, y'all. And maybe this is why gold is quietly rising. Now, I was watching the other day at gold at all-time highs in the gym, CNBC, on the elliptical machine, and they have these boxes that spin underneath the moving ticker, and gold came up, and I'm watching it, and like, something's not right here. So the next time it comes up, I watch it. These boxes flip every 5 or 6 seconds, like NASDAQ, Dow, S&P, and gold's at all-time high, and it says gold 3250 or whatever, and then I count. And it's 47 spins of that box before it comes back up. In the meantime, Bitcoin came up 9 times. 9 times as many references to Bitcoin, which is, $40,000 or more off its all-time high, and yet gold's at its all-time high. No one talks about it. Yeah, there's some people noticing it, but the average person has no idea. We're nowhere near the end of this rally. I think gold will go higher than people think possible. And if Judy's right, we will see it rise continuously into into next year. Gold is nowhere near overvalued. The reason the price is the way that it is because of the rehypothecation. Let's look at London as an example. London is a T+1 settlement exchange where T is the trade day +1. The metal should be moving your way in 3 days. They've switched to T+8 weeks because there's a shortage of trucks. Really, the Bank of England can't get enough trucks to move people's metal. It takes 8 weeks. It's just about as close to a default as you can get. And they have somewhere in the neighborhood of, when we talk about the float, about 36 million ounces. That stands behind 280 million ounces in spot contracts. So, you have, or over 300 million in spot contracts. In other words, you got 10 to 1 paper versus physical. And that's really the problem, is that the ability for these banks for all these years to naked short has distorted the real price. And so the BRICS nations and the central banks have been slowly exploiting that and standing for delivery. So this is a situation where, they have accumulated so much gold, and there ultimately is a shortage of good delivery bars, 400 ounce. On COMEX, there's way more paper contracts than there are bars standing behind it. So, this is something I've always admired the BRICS for, how methodical they are in accumulating metal instead of just throwing everything in the kitchen sink at it.
Gold declined for a second consecutive session as the White House's more conciliatory stance regarding the Federal Reserve's independence and optimism over U.S.-China trade negotiations improved investor appetite for riskier assets. On Wednesday, gold extended its pullback from a record high, dropping more than 3% after President Donald Trump assured markets he has no intention of removing the Fed chair and indicated progress on trade discussions with China. The shift in tone from the administration helped lift equities and risk sentiment, temporarily diminishing demand for safe haven assets like gold. Meanwhile, gold's relative performance against Bitcoin has also softened this week, with the cryptocurrency drawing more attention in short-term trading. However, analysts maintain that gold's long-term strength trend is intact, underpinned by persistent global economic uncertainty and its traditional role as a store of value. Bloomberg reports that investors are now bracing for more mixed signals from U.S. policymakers, which could cloud the outlook in the coming days. Despite the near-term volatility, market participants remain focused on the broader macroeconomic picture. AndySchectman emphasized that seasoned gold investors are no strangers to this price action. "We're used to getting beat down. It's a pattern we've seen for years. Gold rallies, then it gets slammed," he said. But this time, the market feels different. He noted the presence of large intraday swings, declines of $40 to $50 followed by gains of $100, as a sign of underlying strength and growing momentum. And yet it keeps pushing higher, Schectman observed, reinforcing that while short-term corrections are part of the market, gold's structural bull case remains firmly in place. Let's get back to the interview.
When you look at the all-in sustaining cost being as low as it is and the price of gold as high as it is, the miners are raking in the cash. The funds haven't really realized it yet and haven't jumped on, but the mining shares have caught a bid and they are moving higher. Similar to silver, we call it asymmetrical risk reward. Now, to your point, the broader market, the rising tide raises all boats and the falling tide could bring them all down. I agree with that. But again, we use the pyramid philosophy. That's the Swiss philosophy they've employed for 300 years, where the base of your pyramid, 60-70% would be things like paid for real estate, gold, cash. And cash, I hate to say that because it loses ground, but let's just say things that are very, very conservative and low yielding. The middle portion, 20%, would be treasuries, 6-month duration, earning 4.5%, or utility stocks paying a dividend. And the home run at the top is your Bitcoin, your crypto, your mining shares. If you lose everything on the top 10%, all of it, and make nothing on the middle 20, as long as the base is making its 2-3%, you don't go backwards. And, look at gold. It was up 40% last year, and silver up, 12 or 15%. So it certainly did well. The 10-year treasury was at 5%, and your Bitcoin killed it. But mining shares not so much. But this is the philosophy, the uninverting of the pyramid. You don't risk too much to speculation. And so what you did is built a very stable, solid base of your pyramid that gives you the ability to take risks up at the top. And but mining shares, to me, is a once in a generation opportunity right now. And that's how all of us feel who own gold. We're waiting for, to be beat down again, because that's what we've all endured. My whole career, that's what's happened. But it's so different right now, where 2 days ago it was down 40, $50, and then yesterday it's up 110. Today, the volatility, but it continues to march higher. And when I was in Europe a few weeks ago, it goes down $200, and that's the end of it. And then it goes back up higher than where it was. It went up over 300. So I guess I would just simply say that to expect it to be easy, it won't be, because they want to keep as few people off the bull as possible. The bull wants to buck you at every chance. And this is where you have to have strong fingertips. You have to look at the big picture. The most influential money in the world is telling you this is coming. President Trump maybe just hinted this is coming. Don't let the bull throw you off. Don't buy it to get rich. Don't buy it to get wealthy. Buy it because it is wealth. I've wondered for a long time, will they ever stop manipulation? It is stopping. And I know people have a hard time understanding that and believing it, but it is stopping, because the realization that the rest of the world is accumulating these assets is enough to make these commercial banks stop doing this. But one of the things that has allowed them to do it is the leasing of silver. And Basel III will say that you really can't lease these unlimited amount of naked shorts by leasing silver that you don't have, because it will negatively impact their balance sheets. This is what has enabled so much of the manipulation. And come July, maybe we're getting to that point due to physical demand, physical delivery requests, which used to never happen, that are now happening, and the Basel III hitting the U.S. banks. Maybe we're getting close to that moment.
Despite recent price swings, gold's broader trajectory continues to signal strength amid financial unpredictability. The pullback from historic highs hasn't deterred strategic investors who view these fluctuations as part of a larger bullish narrative driven by structural imbalances and growing distrust in traditional monetary systems. Gold's long-term potential remains robust, with increased participation from Western markets, persistent central bank interest, and macroeconomic headwinds. This evolving landscape suggests a market recalibration that may still be in its early stages. Could recent volatility in the gold market be a sign of more profound systemic shifts, rather than just short-term investor sentiment? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.